Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will run down the major equity market's reaction to the British election results. Former National Revenue Minister and editor of the real estate blog GreaterFool.ca, Garth Turner, warns what a downturn in Vancouver and Toronto real estate could mean to your bottom line. He's also concerned BC ndp-green policies could be a negative for the economy, especially if harsh taxation is imposed. Inside Track President Eric Hadik answers the question, do economic cycles shape politics, or do politics shape our economy? We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
How did the British stock markets react to the election results where the Conservatives under Theresa May look like they're going to have a minority government?
Well, Theresa's got to be just wondering what she was up to when she called this election. With the minority, clearly at this point now, you've got to be looking more at a soft Brexit than a hard Brexit in terms of the negotiations. And not only did the markets not really like that, but the British pound got hit as well. So it was a tough day over in Britain. And we had been looking at it during the week, and with Bob's service, with Bob Hoyes, we had actually shown how the indices there in Europe and in Britain, the FES and the EWU ETFs, were up into big exhaustion levels. The markets were just totally overextended, levels that we hadn't seen in the better part of anywhere, depending upon the index, from anywhere from 5 to 15 years. So it's all you needed is one negative piece of news, which is what you got with a minority government, and you turn the corner. So a little bit of follow-through then into New York early in the morning on Friday. But by the end of the day, we'd seen some pretty big shifts as far as the equity markets were concerned in North America. The FANGs, the plus, I guess, Microsoft you add on to that one, have been having just an excellent run for the last number of months. And, we talked here a few weeks ago about how the banks were starting to look nice and oversold, and it was probably a good time to take a look more at a potential shift as far as value versus the growth. And the week ended off with a pretty rough stretch as far as the FANG stocks are concerned, down anywhere from 3 to 5% across the board. And it's looking like that transition phase now is going to be upon us. Summer tends to be one of those clean-out periods, especially when you've had a big run. And I would suspect that you're looking maybe in the sort of the 6 to 8 week window for these high flyers to settle back and try and find some much lower support levels.
What's happened with gold because of this action?
Well, the gold early in the week, it managed to pop through into the 1290s. It started off the week pretty well. There was anxiety ahead of the Comey testimony, ahead of the British election, and upcoming next week, you've got the potential for the rate hike from the Fed, probable rate hike. So you had seen a bit of a flight to quality or to safety as far as the markets were concerned in the early part. So gold was up through the 1290. Bond market was very strong. But by the time we got into the middle of the week, gold had pulled back, and it had originally been up through a major resistance line. If you take a look at gold all the way back to the 2011 top, and you draw a nice standard trend line coming down, it managed to poke its head out of that for the first time in 6 years now, just literally for one day, and then backed right off again. So on the other side of the coin, the U.S. dollar, which had been very weak into 2 weeks ago, it had a small bounce and then was back down to the 96.60 level, which is what we've been talking about for this last 2 to 3 weeks as a potential support area. So it had a good chance to test that. Big reversal in the second part of the week on the dollar, and with that, gold's back down here into the 1270s. The mining stocks could not rally with the gold rally. They failed at much lower highs than they have been putting in the last couple of months. So I think we're looking at some vulnerability as far as the gold miners are concerned as we move into the next few weeks here.
Ross, oil seems to be slowly stepping down in price. It'll go up to 50, then drop down to 46, then up to 49. Are we going to see a continuation of this kind of step down?
Yeah, I think the slow erosion process is still what we've got in play here. It had looked as though when we were starting to break down about 2 months ago that might be the beginning of the really hard move, but we bounced back into that $50 to $52 range, and now we're starting to erode. And every time you get a piece of good news, we get minor rallies, and then when you've got anything negative, it's getting hit. So it's doing more of the stair step down. 42 still for us is that initial measured target area. We still haven't been down to there. We did a 44 3/4 a month or two ago, but I think 42 is still a pretty reasonable number. If you start to push through there, and the dollar stays firm, the U.S. dollar, then you could see a pretty bad erosion definitely into the somewhere down into the 40s as far as oil is concerned. So I think we got to be watching the currencies as much as we have to watch the oil. And OPEC has done their thing. I don't know, how much more we can expect from them now that they've got this 9-month window as far as their production ceilings have been set. So yeah, we'll see how it unfolds.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Garth Turner next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Garth Turner. He's the founder of the real estate blog greaterfool.ca. He's speaking to us from Toronto. Garth is also a former National Revenue Minister. Garth, welcome back to This Week in Money.
Pleasure, Jim. Thanks for having me.
BC looks like it's headed for an extremely rare coalition government by just a 1-seat margin. Will this cause instability for the province?
Well, we'll wait and see. It's hard to say. Coalition governments, by their nature, are not necessarily a bad thing at all. You do get compromise because people have to compromise in order to retain power and move ahead. When you've got majority governments, often you can get arrogance and an attitude that the government was elected by the majority of the people, and therefore they're going to do whatever the hell they want. That's rarely the case in Canada. You take a look at the federal government right now. They have a majority, but they only received a little over 40% of the vote. So 60% of people didn't vote for that. So there's nothing wrong with the coalition government. Having said that, the coalition in BC is definitely left-leaning when you get Green NDP. So it's probably going to take the province on a path that has not been tread for a few years. It may impact some investment decisions energy companies and others make about BC. We'll just have to wait and see. But I don't want to be alarmist about it at all. These guys may end up being pretty responsible. You just never know, Jim. We'll have to see.
A government with a one-seat margin is not likely to last long. Would a new election with a larger majority government likely bring stability to the BC economy?
Well, maybe. It may bring stability. It may not. I think that this particular government is going to be problematic for economic growth. And you've got the kind of two big engines in BC now, energy and resources, commodity, very important for British Columbia. And there are threats right now. The whole energy sector is weak because of oil prices that kind of refuse to get above $50 a barrel. You've got the whole LNG natural gas situation, which is mired in controversy. We've got the softwood lumber tariffs from the United States, which is now a very protectionist country. And then, of course, the other big engine is the housing market. And, you know, these guys do have definite views about how they want to cool the housing market. It could send it into a deep freeze. We'll just have to see. So there are certainly some clouds on the horizon, and we'll just have to see how they develop.
The likely NDP-Green coalition wants to target the real estate market with a number of taxes. Will that lead to a good market for buyers and renters?
Probably. Now, there's campaign rhetoric, and then there's reality. So we don't know what the reality is going to be yet because we don't have any track record for a coalition government of this nature. However, we do have lots of rhetoric from the election campaign. And if the promises of the election campaign are in fact brought to reality, yeah, we got a pretty serious impact on the BC residential housing market. Taking the foreign buyers tax in that's applicable to Vancouver now and spreading it right across the entire province is a big deal. And that certainly is something that the coalition government is likely to do. We've seen a lot of money, you know, that got diverted from Vancouver. A lot of people think it went to Victoria. And Victoria's prices have certainly popped up since the buyer's tax went in. And so there may be a direct connection there. If that's the case, yeah, well, Victoria's going to take it on the chin. Money's gone into the Okanagan. Money's gone elsewhere in the Lower Mainland. So that may be an impact. And secondly, there's the rhetoric of, well, we're going to take the foreign buyer's tax and double it to 30%. Oh, my God. Well, just, you know, do the math on that. Take a nice, you know, cheapo $1.5 million shack somewhere in East Vancouver and add 30% to it, and you have got a giant disincentive for anyone to buy that. There's the empty houses tax, and that's just going to start coming into play next month, and that's going to be, you know, possibly extended as well. So there's a number of measures there that I think do have the potential of maybe doing to Vancouver what just happened to Toronto.
Are various forms of consumer debt in BC nearing danger levels?
Yeah. Consumer debt is ginormous in Canada right now, and it gets flagged by everybody who has a look at the situation. And the latest was the Bank of Canada, which just did it again this past week, saying, you know, we got a real vulnerability here, and it's consumer debt. I actually wrote a blog about this the other day about HELOCs, home equity lines of credit. And they're $200 billion now. That's billion with a B. $200 billion. Unbelievable. 1/4 of all Canadian households have a HELOC. And 40% of the people with a home equity line of credit are not making payments. That's stunning, isn't it? But that's the reality. So this debt is just adding, clicking higher all the time. We now owe more than $2 trillion in household debt, which is bigger than the entire economy. And 65% of that is mortgages. So when you combine the mortgage debt and the home equity line of credit debt, which is, of course, done on houses, you got 90% of consumer debt is attached to residential real estate. And guess where the worst numbers in the country are? Absolutely, they are in BC. There are more people in distress in Alberta, but certainly the biggest debt loads are in British Columbia. And British Columbia continues to have a negative savings rate, Jim, so that means in general people are spending more than they're making in aggregate. Boy, that can't go on forever, can it?
People paying credit cards with their other credit card?
Somewhat. But again, back to these home equity lines of credit, a lot of people are taking them to pay off credit card debt, which, makes sense to a certain extent, because your credit card may be costing you 12, 15, or 19%. Your home equity line of credit generally is prime plus a half. And the prime rate right now is 2.7. So generally speaking, you're going to be around 3.2% for a home equity line of credit. Well, that's one heck of a lot cheaper than 12 or 15%. So people who do consolidate debt into home equity line of credit, there is financial sense to that. But once you stop making payments on that debt and you just let it sit there and you're making interest-only payments, then it's not so smart anymore. And we got a lot of people doing that.
Could political instability affect investment dollars coming into BC and the job market as well?
Yeah, I think so. I think that governments that are capriciously and whimsically taxing citizens and sending out a message to people who are not residents that you're actually not welcome here and your money is not welcome, and we're going to tax you if you show up. We're going to tax you if you buy a house. And there are two sets of rules. It is negative. Of course it's negative. Just imagine if Florida or California or New York State started doing that. Well, you'd have a lot fewer Canadians wanting to work there, to move there, to invest there, to buy homes there. And that would impact those economies. And it's even more so in a small country like Canada where we need foreign investments. So I think it's a really bad idea. I know I'm in the minority here, and I know poll after poll in BC, people really truly believe that somehow folks from away are responsible for high home prices, but they're not. I have seen no statistical evidence of that. People in BC want to spend incredible amounts of money on their houses, and they want them to keep going up. So I do think it's a negative sentiment if this foreign buyer's tax is extended to the entire province and if it is doubled, and I think both of those are highly likely with this government. There will be negative long-term consequences, yes.
When you use taxes to do almost anything, is it almost like using a giant sledgehammer to kill a fly?
Yeah, taxation is a very blunt instrument. Governments have to be careful about that. And again, back to the election campaign. Well, we're going to tax this, tax that. We're just going to slap it on here and there, and that's going to fix the problems. Well, it's not. Like the Empty Houses tax. The Empty Houses tax is not going to add any housing to the rental pool. That's just absurd to believe that. All it is a tax on the wealthy. It's a tax on people who have multiple homes. It's a tax on people who have second homes. It's not going to cause anyone to, oh my God, I better rent this out quickly, instead of having it sit. I just don't think that's going to happen. Nobody who's bought a mansion on the west side of Vancouver for $4 million and it's empty right now, they are not going to turn around and make it into a boarding house. It's just absurd, this philosophy, but unfortunately it just permeates those who've been recently elected. It does make me a bit concerned for what comes next.
NDP leader John Horgan reportedly has sent letters to BC Hydro asking them not to sign any more contracts for the giant Site C dam building project. Is it premature for him to presume that kind of power?
Oh, sure it is. It's arrogant. I think it's going to come back on him. It's ideological. This is like Donald Trump getting into office, signing a bunch of executive orders that are, stupid and illogical and actually illegal. And you know all the trouble he's gotten into because of things like his Muslim travel ban. So I'm not saying this is in the same category, but it's in the same spirit. These guys have got to form government. They've got to get into the legislature. They've got to present a legislative agenda, a course of action, a budget, and they have to proceed in an orderly fashion. Simply being ideological and getting into power and dashing off some letters is the wrong way about it. But these are people who have not been in power before. They got a lot to learn, and I think this is one of those lessons.
Of course, Trump is being excused for a lot of things he's done, saying, well, he's a rookie politician, except you're just practicing on the world's largest economy.
Yeah, exactly. Well, you got to blame the voters for that. Voters keep saying, we need something different. We need some non-politician in there with, fresh blood, and he's going to fix it up because, this is all really simple stuff. And, if you just had some common sense instead of these political class people, everything would be fine. Well, of course, that's not true. Everybody goes into politics green for the first time. They don't necessarily or usually go in it seeking power. They're trying to make change. They're trying to, like everybody's got a reason that they went into politics, something that they think can be better. But knowing how politics works, and how the system works, and how government works, which is a highly complicated and complex machine, it takes a while to figure that out and to know what to do. And especially leaders. Like Trump scares me a lot. I don't know if he's going to blow up or not, but there's damn good odds that he will. So, and that's going to impact all of us. Trust me. I'm concerned about NAFTA. I'm concerned about our free trade agreements. I'm concerned about 70% of the trade between Canada and the United States. BC, Ontario, very dependent on that. Of course, Alberta with the oil. So, yeah, there's a lot of risks out there right now, Jim, and I think it's time for caution.
We'll have more with Garth Turner next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Garth Turner. His website, greaterfool.ca, and he's also a former National Revenue Minister. Garth, BC is now considered a housing economy. What happens if the booming housing market disappears?
Oh, well, we got big troubles. No doubt about it. I think the housing market is consuming so much of the economy right now that no one's going to let it collapse or fail if they can possibly help it. Right now, nationally, we've got about 20% of the entire Canadian GDP, or gross domestic product, is related to residential real estate. That's a record. I'm kind of think it's a record around the world. I'm not sure. I've tried to do some research on that, but as far as I can tell, I don't think anyone's ever let their national GDP become so dependent upon an emotional asset like residential real estate. But nonetheless, here we are. It's even higher in British Columbia. definitely about twice the level that it was in California in 2005-6, when that economy basically started to go bankrupt because housing collapsed. I think, Toronto and Vancouver are definitely different markets for a lot of reasons. Toronto's one heck of a lot bigger, more spread out, more diverse economy. BC is more speculative driven, I think, than Toronto, where you've got people in Vancouver who are obsessed with real estate more than Toronto, and it's become probably, I don't know, it's almost a way to make money and a fashion that is impossible in any other commodity now in people's minds. So we've got a highly speculative situation in Vancouver, but we have weakening fundamentals. Interest rates will be creeping higher. The U.S. Fed will be raising interest rates again on June the 14th. That'll be the third increase in roughly 6 months. There's maybe one or two more coming this year. The Bank of Canada is expected to follow suit in the first quarter or the first half of 2018, and meanwhile the bond market should be forcing up some longer-term interest rates. So we have that risk. We've got the Trump risk. We've already talked about that, the potential of trade deteriorating. We have economic fundamentals that haven't improved a lot. Average wages have not gone up in Canada. So you've got a tremendous overreach in terms of household debt, and we just talked about that. So there's a lot of negatives now, and then you layer on top the Green NDP coalition government and the potential of all these new taxes driving away other sources of investment capital. So I think what is happening now in Toronto could happen in Vancouver, and what's happening in Toronto seems to be pretty serious. In the last 30 days, sales plunged by 20%, prices went down 6%, listings went up by 47%. 6% drop in price doesn't sound like a lot because we're still like 15% ahead year over year, but 6% in a month is giant. It's huge. It's almost never happened before, and in fact, it's never happened in the spring before, which is the prime real estate market. So if we get 2 or 3 or 4 more months like that, you have a real estate decline that will be on the magnitude of that which happened in the United States. That, well, we all know the consequences of that. So this is a big deal, and we don't quite know how this is going to unfold next. But if Toronto does have a 30% decline over the course of the next 6 or 8 months in real estate prices, there is no way that Vancouver is going to be able to withstand that. This is probably the biggest economic threat we face right now, and that's exactly why the Bank of Canada was squawking about it again this week, why every rating agency and every major economist has been on the same page. Maybe sometime, hopefully, Canadians will listen.
Is BC now considered a housing economy, and what happens if the booming housing market disappears?
The short answer, yes, it is. It's forming the greatest single element of the provincial GDP now. So it is essentially a housing economy. We already talked about how much debt BC residents have. And, of course, it's almost all related to residential real estate. If there is an equity decline, it is going to hit personal finances rather hard. So, again, it's a concern now that we've got a government that seems destined to cool the real estate market and certainly try to curb speculation. So, Jim, I think it could be quite a negative. And if you've got an ndp-green coalition, which is going to be increasing government spending quite a lot, which obviously they've said they will, then you've got higher taxes to finance that, plus a higher provincial deficit. So the years of a balanced budget could be gone. I'm sure they are, and it's probably going to be 4 or 5 years now of increasing deficits.
So many governments have run up giant deficits and look back and say, well, see, nothing bad has happened, but could it happen and will it happen?
I don't know. Don't want to be alarmist. Have no idea. I think the potential is there. It wasn't there a few months ago. It's there now. That's pretty much all I can tell you. People are just going to have to watch this. And, this impacts on individual finances. People need to be careful right now. This is not the time to go out and be buying a home at the top of the market. We're not going up another 40%, folks. Get used to it. The markets are already in decline. You just don't see it. Real estate numbers from the boards, from the realtors are carefully manipulated and designed in order to mask month-to-month changes. There's something called an HPI, or House Price Index number, which the real estate boards manufacture, that really is designed to give a rolling number, so you can't get a good, accurate month-to-month reflection of what's going on in the marketplace. So, people got to be careful.
You're listening to This Week in Money. We're chatting with Garth Turner, former National Revenue Minister and editor of the popular real estate blog greaterfool.ca. The Toronto real estate market is topping 1 year after the Vancouver market. What caused these markets to top 1 year apart?
Well, the BC market was rolling over months before the foreign buyers tax came in. Sales were down 70% in some areas, Burnaby, Surrey, Richmond. So the market definitely had hit a point of unaffordability. And then the foreign buyers tax came in. It could have been anything, but it was that. And that was just an extra impetus for people to say, maybe this isn't a great time. So the market went down in general. It's recovered a bit on the bottom end, not the top end. And now you've got, BC's home down payment plan for first-time buyers. So a lot of young people think, it's sort of free money and the government's encouraging them. So the bottom end of the market is pretty vibrant right now, and that's where you're getting the bigger sales numbers. But the top end of the market, like people moving up, selling homes, and moving up to other homes, that part of the market is pretty much decimated right now. So we are seeing a lot happening in Vancouver that just isn't evident. In Toronto, it's declined right across the board. And it's exactly what the government wanted. They brought in a suite of 16 changes. So the top end of the market was certainly hit by unaffordability. Foreign buyers tax as well came in, but I think more significant was universal rent controls, because we've had a lot of speculation in the condo market. People buying condos, renting them out. And now that there's universal rent controls, people know that if they buy one of these units, they are going to be in negative cash flow for as long as they own them. There's no way that rents cover the purchase price. So that makes no sense unless you're getting year-over-year capital appreciation in that residential unit. And I think that now evidently is gone. So that's why we're seeing so much downward pressure. And Toronto is just on the cusp of going from a seller's market to a buyer's market. I expect that to happen very shortly.
Is Home Capital Group a canary in the coal mine for real estate in Canada?
Sure it is. It's a visible symbol. I think it rattled people because it came at just about exactly the same time that Ontario was bringing the hammer down on the market. Home Capital only amounts for a small percentage of the overall national real estate market, but they account for a big proportion of people who need additional financing. They can't get it from the banks. And they're overrepresented in Ontario and the GTA. So it's definitely having a downward impact there. But I think it's the sentiment too. People hear about a mortgage company in trouble and they just kind of tune into that and think, oh, gee, that's not good. The market must be staggering. And so I think it just goes into the pot. It is a canary in the coal mine to a certain extent. There are going to be fewer loans made now because of that trouble that Home Capital is having. I don't think Home Capital is going to exist for many months more. It's looking for a buyer. It will be subsumed somewhere. And because Home Capital has stopped making a whole bunch of loans, because they don't have the capital anymore to loan out, you're seeing a lot of the other subprime lenders getting more business, and their rates are going up. So for non-conventional lender mortgages right now, we're seeing 7, 10, 12% interest rates being charged. My God, that's pretty withering.
What causes banks to constrict credit?
Risk. That's it. And when they perceive there's more risk in the marketplace, they're going to loan less or charge a higher rate. And we're kind of starting to see both of that. So there's less subprime money around right now. We just talked about home capital. And that lower amount of capital means that the money that is available is being lent out at a higher cost. The big banks are definitely constricting capital now. Appraisals are being done for below market value, and market value has gone down in many areas. And the banks are kind of purposely coming in at 20, 25, 30% less on their appraisals in terms of what they're willing to lend. So it's really about risk. I think you're going to see this starting to rear its ugly head with the home equity line of credit market as well. Again, $200 billion outstanding in HELOCs. All of it's on floating rate debt, and it's all demand loans. Most people don't understand that when they get a HELOC. They think it's, it's okay. It's like a mortgage, but it's not. You can get a call from the bank at any time telling you to pay it all back or part of it back, or your rate's going up. I think that's the next shoe to drop.
I'm just going to ask, are banks likely to call various types of loans going forward?
Yeah, good question. Yeah, well, that's where I see the danger. Mortgages are locked in. If you've got a mortgage, if we do have a real estate correction, if prices go down for 2 years, you come up to renewal, your house has lost equity, you can be refused renewal. No one has to renew your mortgage. Or you could be asked to make up some of the equity difference. That's a possibility depending on your lender. But I think more likely are these home equity line of credit because they are demand loans. When you read through the agreement, you'll see that you have nothing locked up. This is really at the pleasure of the lender. And I think they're getting concerned. As I said before, 40% of all outstanding home equity lines of credit in Canada, borrowers are paying nothing on them. They're just letting them sit there and accumulate.
What is power of sale and how does it work?
Well, if you can't make mortgage payments, let's say you miss a payment, you get a little letter from the bank. If you miss a couple, maybe your bank has one of these programs where you can skip a payment or two and they'll just add that to the principal. But if you miss, 3, 4 payments, you're going to get a lawyer's letter telling you that you have to make good on your mortgage or there will be consequences. And of course you have to pay for that lawyer's letter. That's your cost. So if you don't, if you just kind of let it slide, you will be served power of notice sale. It varies from province to province. Like Alberta has foreclosures, Ontario has power of sale. It kind of varies. But generally the process is your lender, your first mortgage lender, they can't take your house away. They can't kick you out, move your mattress onto the lawn, and put your kids in the garage. They can't do that, but what they can do is they can force the property to be sold. That's called a power of sale. They have to sell it at market value. They can't sell it at 50% off. It's got to be at market value. Of course, market value, when there's lots of powers of sale around, is going to go down. So it's probably not going to be what you want. But they can sell your home. They can force it to be sold. And the proceeds that are raised are then applied to the outstanding mortgage principal. If there's any money left, you get it after costs. If there's money owing, you have to pay up, plus costs. So that's pretty much the process. And then, of course, when it's sold, it's sold. You have to move on.
How do you find power of sale properties? Or is there any advantage to it?
Oh, well, there's certain websites around. You can look for them. You can do a Google search, power of sale for your particular area. You're going to get a bunch of websites. Be careful. Most of them are frauds. They're just junk. And a lot of them are U.S. based. They got a different system in the States where, foreclosure homes can actually be huge bargains. But our law says, as I just stated, that if somebody is your lender, and they're forcing you to sell the house, that it's got to be sold at market value. So power of sale websites may make you think you're looking for a big deal, but at the end of the day, you may not be getting a deal at all. You may sometimes, but don't get your hopes up.
Garth, thank you so much for being on This Week in Money.
My pleasure as always, Jim. Thank you so much for having me.
My guest has been Garth Turner. His website, greaterfool.ca. He was speaking to us from Toronto. Coming up, Eric Hadik, next on This Week in Money.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, president of InsideTrack.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Some people have asked me right now, we know that you like to rely on some very consistent cycles. And so my question is, do the politics of the times follow the cycles, or do the cycles force the politics of time? And I'm thinking back to the 1930s, where you saw the rise of Mussolini and Hitler, and they thought that's the kind of solution you needed to massive unemployment and a lack of industrial output. What happens? Do the politicians actually follow the cycles, or the cycles created by the politics of the time?
Oh, I think it's, and now obviously I'm biased, but I think it's pretty clear that the cycles are the governing factor. And, if you go back over hundreds of years, you see these swings, the pendulum going from one extreme to another, and monetary cycles, which then certainly prompt political action and reaction. And that's even so inherent in and so obvious in the 40-year cycle that I've done so much work on. And even if you just look at American politics along with that cycle, and you see how monetary and even natural swings that they impact mass psychology, and politics are often the reaction to that. And I even look at some of those examples I give, like the 1850s and what was going on then with the battle over fiat currency versus gold and silver, and first the reduction of silver in the coins, and ultimately leading to suspension of it. And then 40 years later, in the 1890s, you have the battle had been building and building again, and ended up kind of culminating in the election of 1896. So right there, you've got your politics reacting to it. But the whole election was over the gold standard. And you go into the 1930s, and like you said, you have another swing economically, and what's right at the forefront of that? The confiscation and suspension of gold and silver. And then you go into the 1970s, and you have kind of an opposite, starting with the collapse of Bretton Woods and the Nixon gold shock, even before that, leading to the inflationary period in the late 70s, and your political reaction to that. So I think that the the politics is always more a reflection and an effect, not a cause.
Do you think politicians and people at the central banks give themselves a whole lot more credit for what has happened than they should? Because I know they certainly don't take the blame.
Well, I certainly think that they have some influence and impact. Their rise to power is often a result of those cycles and the political landscape and the psychology of the day. And I don't minimize the impact of some of those decisions and what they do for the next cycle. But how great an impact that, I don't know. And but I'm sure that many of them do fancy themselves as the do-all and end-all and the major influence in that. But I think there's a lot of much bigger influences at work that most people are unaware of and don't really want to know about.
Well, in Canada in the mid to late 70s, we saw wage and price controls. They did keep wages down, but they didn't keep prices down. Did governments overestimate their power to influence once we find ourselves at, I call it the wacky end of one of these cycles?
Well, and I think too that you see a lot of those decisions take time to play out, to really mature or ripen and come to fruition. And I've even argued that with agriculture and food crises, but also the responses to those food crises. And again, you look at more recently, first the 1930s and the Dust Bowl, and many of the things that came out as a result of that. And then the 1970s, you had kind of almost opposite reactions from all the subsidies that were enacted back in the 1930s. Then you had, in the 70s, Nixon's agriculture secretary and just really pushing the fence row to fence row corn cultivating. And now that has had its own impact, and you can trace that a lot of directions. But even when you look at the whole food chain and what that abundance of corn has done to the culture, going all the way down to things like your cheap sweeteners that you find in everything now, and the rise of health issues in adult set diabetes, and you can take the cause and effect out several levels and begin to see that each of those cycles certainly times a different phase and a different reaction, but you can see the connection and the thread that's running through them, and it just kind of comes to a head at each phase of that cycle. And as I've pointed out many times, the second half of the 2010s is the next phase of that, of a 40-year cycle, an 80-year cycle, a 100-year cycle. There's a lot of them all kind of coming together and colliding in this approximately 5-year period in the second half of the 2010s.
Eric, what kind of things do you foresee happening here in the last half of the 2010s? As you said, several cycles are about to kind of collide.
Well, I think that we are in for another stress or challenge where food and crop production is concerned, production or distribution. I think that you've seen on each phase of that 40-year cycle, you've seen some big spikes in food prices. So what the actual fundamental driver of that price spike is, even that oscillates pretty one extreme to the other. So it could be a lot of things, and there's certainly a political factor to that too. So kind of boiling it down to its lowest common denominator there is I am looking for a run-up in certain specific commodities, particularly in 2018, 2019, and there's a lot of reasons I give for that also deal with solar cycles, with climate swings, and a lot of related cycles that I'm really looking at out over the next 2 to 3 years to start to create more of a challenge. But one of the big things that I alluded to a couple minutes ago is that whole battle between hard currency and fiat currency, and that has been as consistent as anything in this 40-year cycle. And I think that we're seeing that, and again, each time the cycle, it rhymes with the past events, but doesn't exactly replicate them. There are similarities, but there's also distinctions as those cycles evolve and as mankind evolves. And one of the things that's really starting to gain a foothold in just the last year is the cryptocurrency demand, and no longer just Bitcoin either. That when you have Ethereum and Litecoin and a lot of these others that are starting to pop up on the scene and gain a lot of demand, you see the seeds being planted for another big battle between what is recognized as true valuable currency.
Right, and what is a true currency? I know Bitcoin, they said they have a limited set supply, so you have a value on that. But anybody who knows how to create algorithms can create a cryptocurrency. So it could be endless. The Zytgoat currency, well, now there's the Hyper Zytgoat currency. So, would they hold their value, and could people just, again, like every country has its own money, create basically their own currency without any end to it?
Yeah, I think what you're seeing now is certainly the early stages of a shift, and I have no idea what the ultimate manifestation of that whole transition will be, just based on history and normal sequence of events. I'm guessing that a lot of what you see today will only mildly reflect where we ultimately are even in 5 years from now. And often the pioneers, the first ones in any revolution or innovation, are not the ones that ultimately become the standard or the most profitable or the longest lasting, but they certainly helped pave the way for the ultimate realization of that shift. So, from right now, I'm looking at these cycles, and I'm looking at how it's impacting the dollar and other currencies, and also how it's impacting gold and silver.
Eric, what kind of impact do you see on gold and silver as cryptocurrencies become more popular?
Well, I think that gold and silver are certainly fighting for the attention and the appeal when you have some of these more uncertain times, and even the first half of 2017, where you've seen the dollar slowly edging lower, and that's picking up some steam in recent months, and so as there's growing concern with the dollar, you're seeing some of that money flow into gold and silver, gold in particular. but the moves are certainly not that long-lasting. But then you look at the moves in some of the cryptocurrencies, and it's been more than impressive over the last 6 months. Interesting enough, I've got a lot of these more shorter-term weekly and monthly cycles kind of coming to a head in June, middle half of June, in all of those markets, in the dollar, in gold and silver, and even though I don't like to venture too much into something so in its infancy and with so little data as the cryptocurrencies, there are a couple of short-term cycles and price targets that I've been looking at, and they've kind of started to show some adherence to certain normal cycles that I look for in markets. And if they're going to continue to do that, the middle half of June is when I could see another spike high and reversal lower, at least for a few weeks. So I do think that we're kind of entering an inflection point. And even when I look at the dollar, it's very interesting to me. If you look at the last 2 to 3 years, the dollar has had 3 sizable corrections. Each one of them lasted 22 to 23 weeks in duration. Each one of them consumed about 8.5 basis points. I think that's around 8 to 8.5 basis points. And I should say the first 2 of those 3 lasted 22 to 23 weeks and consumed 8.5 basis points in movement. The third one, which started in the beginning of this year, has just entered its 22nd week and is within less than a basis point of matching the magnitude of those 2 previous. So you have a very similar wave pattern, wave structure that the dollar has undergone since March of 2015. But that also tells you that this current correction is now entering a 1 to 2 week period and about a 1 to 2 basis point support level where it's kind of do or die. If it were to extend its decline beyond that, then we're talking about a much higher level drop that is unfolding in the dollar. Right now, I'm looking for a bottom in here in the middle half of June, and that's another reason why I'll be really interested to see how, particularly the cryptocurrencies, if the dollar starts to show any resilience, any stability, is that going to impact any of the appeal, or is it, there's multiple levels of distinction between them, so there's other factors that could continue to drive the cryptos even if the dollar starts to show some stability. But your big moves in Bitcoin and Ethereum and others have really been the last 2 months when the dollar saw a little bit more of an accelerated move down. So there certainly is some inverse similar movement, whether it's a direct correlation or not is debatable, but when you're watching the charts and watching the cycles, I see enough there to make me at least stand up and take notice and start to build some expectations for the coming weeks and months.
Could cryptocurrencies disappear overnight if governments decide to make them illegal?
I wouldn't say I know enough or an expert enough to really answer that intelligently. I could certainly see any time there's, an announcement or a news thing that impacts it, having a big move in those. But I think the longer that they're able to gain a foothold, the harder it would be for for governments, especially if it is just a unilateral thing with one or a couple of governments doing it, then the demand and the activity just kind of shifts a little bit away from that. I don't think it's as simple as a 1930s, and I don't even know if that was simple, but confiscation of gold and silver and outlawing them. I think that the computer age has made a lot of that much more difficult. So I think you can see reactions, even like, a couple months ago when what was it, an ETF or something that Bitcoin was trying to develop, and there was either a ruling or something against it, which it took a pretty good hit. I think it lost about a third of its value in the middle half of March. But it also kind of picked itself back up, brushed off the dust, and took off from there. So, I don't know that there's one or two things short of a major event that suddenly gives more powers to governments. I just don't see them disappearing overnight like that with what has evolved over the last several months, over the last several years, and just this a greater acceptance of some validity of the cryptocurrencies. So I think they're probably here with us for the foreseeable future, but I'm sure that their form is going to continue to evolve and possibly shift dramatically.
I know some people laughed when Richard Branson said he would accept Bitcoin to pay for future space trips with Virgin Spaceways. And at the time, the equivalent to $20,000, whatever the cost is, would have been a real bargain if you look at what the Bitcoin is worth now.
Yeah, I mean, and you look at some of the up-and-comers like Ethereum that was, around $8 or $9 back in November, December, and now it's over 250. You talk about a parabolic move. There's one right there.
So are investors now and into the future, when they say you should have a balanced portfolio, will cryptocurrency be part of that portfolio?
I think there still is. It's like so many things in technology. You certainly have that small minority of people on the cutting edge driving movement and driving price. But as far as being in portfolios and balanced portfolios, you got to get rid of some of this volatility before you're going to see a more universal acceptance. When, even intraday you can see $200 and $300 swings in the price of Bitcoin, that's not something that most people are looking for in their portfolios. So I think there's a lot of factors need to kind of smooth out before you're going to see that type of use and acceptance of it.
In other words, don't throw all of your retirement cash into Bitcoin.
Well, it's like anything like that. It's the perceived value by someone else, and who's, buying and selling art for the longest time is looked at, and many other things. Art might not be the best example. But as long as there's someone else willing to pay more at some future point, then great. But you need to be cognizant of all the different factors that would impact not only the value of it, but your ability to liquidate it if you needed to in a pinch, especially if all of a sudden you did have some news that was driving the price lower, and a lot of people wanted to liquidate their cryptocurrencies.
Looking at things that you can actually hold in your hand then, gold and silver still a good idea to have a decent amount in your portfolio, just in case these cryptocurrencies don't really turn out to be real or something worth putting your valued assets into?
Well, I think gold and silver certainly has a longer historic acceptance rate, so that alone is going to give investors more a sense of security and peace of mind. And there's all types of things that would factor into a balanced portfolio. So the cryptos are at the far end of the investment spectrum. So your high risk amount of investment money, sure, there may be a place for some in the cryptocurrency, but also when you have what appears to be, if I use the term bubble right away, that becomes very incendiary, but certainly a parabolic move going on in a lot of those cryptos. The big question becomes, are you just in the middle of a big accelerated move? Are you very close to the peak, in which case waiting for a nice sizable correction becomes a more prudent approach? I just, whatever percentage is in a portfolio is really gonna hinge on that person's risk comfort levels.
Where are we in the gold and silver cycles right now?
I think that gold and silver have been building a base. I thought that 2016 was going to be the first signs of a bottom, and then 2017 would have some similarities as far as the up-down movement. So it's still kind of building a base, but it's starting to shrink the cycles between the subsequent lows, and also those lows start to angle upward a bit more, and that kind of preps the stage for a bigger move up later in this year, and even more so looking at 2018, 2019.
Is oil also part of this cycle?
I know I sound like a broken record, but since I think even titled one of our interviews back in early 2016 something about no big move up for at least 1 to 2 years, and that remains my outlook, that major cycles for me certainly bottomed in the early months of 2016, but as I said back then and continue to say, I think that the amount of damage that was done, even in the couple years prior to that, with crude dropping from over $100 a barrel down to below $30, that's something that takes a lot of time to kind of wash out in the markets. And coming into 2017, I said I thought we'd see our most significant lows in early May, and then in the September-October time frame, we got the sell-off into early May that I was looking for, and I think you're probably looking at a lot of volatile consolidation for a few months here, but then I'm going to be watching much more closely and scrutinizing the technical action of it in September and October, because I think that will be the potential for a more significant bottom and the start of a more convincing advance after that time frame.
Eric, thank you so much for chatting with us.
Thanks so much for having me, Jim. My pleasure.
My guest has been Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Garth Turner, and Eric Hadik. And thank you for listening. If you have any questions for us or our guests, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.